Good morning and welcome to Solder Brothers Emerging Companies Limited April webinar. My name is Greg Taylor. I'm the head of equities at Solder Brothers, and I look forward to providing you the update today. As many of you are getting accustomed to, we do a monthly update on the portfolio and key drivers and thought pieces around the construction of the SB2 portfolio. And today I'm going to talk to you a little bit about the recent uncertainty and sell-off in the global equity markets, what's been behind that, step back and have a little bit of a look at fundamentals and of tariffs and how economies work and how this flows through to global equity markets. And I'll tie all that into a view on the potential impact for Australian small cap equities and in particular the SB2 portfolio. And then we'll just recap on recent performance and portfolio positioning. Again, just by way of introduction for those I've not met, my name's Greg Taylor, and I said I've been managing the Solder Brothers Emerging Companies Limited portfolio for over 3 years now. I have over 25 years experience in managing listed small caps, and so I'm drawing on all that experience at the moment to sort of take a step back and observe this recent volatility and uncertainty we've seen in equity markets, and to share some of the learnings that I've been fortunate enough to have, living through multiple disruptions in global markets such as this, and as we go ebb and flow through cycles. So again, just recapping, Solder Brothers Emerging Companies Limited is a listed investment company on the ASX under the code of SB2, and our mandate is focused on investing in Australian companies with a market capitalisation of less than $500 million. So it very much offers a professionally managed and diversified exposure to the Australian small cap sector. Again, pleased to report the SB2 has a greater than a 3-year track record of outperforming the small cap market, and that's been achieved with the team that is in place at the moment. If you look at the most recent 12 months through to the end of March, the fund achieved an 18% positive performance, which outperformed the market by 14% over that same period. And we've spoken about in the past that the SB2 fund as a listed investment company trades at a discount to its underlying post-tax net tangible asset value. We've seen that discount reduced down to below 25% more recently, though it has crept back out to 32% discount to the asset value at the moment. So very interesting. And just to remind everyone, this month of April, the fund will be paying its inaugural fully franked dividend. It was announced a couple of months back, but the payment of that dividend is occurring later in April. And at the current share price, that's providing a fully franked dividend yield of closer to 6% at the time of this presentation. So interesting times for sure. Okay, again, just to touch on today, the intention is just to talk about the recent extreme volatility and sell-off in markets, but really try to bring that back to fundamentals and putting aside the hysteria and trying to focus on likely where will all this land, what will be the economic and market implications, and what does that mean for again, investors in Australian equities and in particular small caps in the SB2 portfolio. What the conclusion that can be drawn is that despite a lot of media attention, especially around the US president and his volatility, the impact directly on Australia from the tariffs is expected to be quite subdued. What is unknown is the secondary or flow-on impacts of what a global trade war looks like for the Australian market, but it increasingly looks like this is turning out to be a USA versus China trade war, and obviously China is a key trading partner of Australia, so we need to keep an eye on the flow-on impacts of that. One for our own GDP growth, but also just more generally a deterioration in consumer and business confidence in the Australian market, which is a risk without doubt. But what we do is that we will step through recent market volatility relative to history and other parts of the cycle and look at the SB2 portfolio. But sort of jumping to the conclusion before we go into the detail, but the view is that what we're seeing is not a complete dislocation of fundamentals or economic or market principles. Absolutely, short-term volatility is expected to continue, though the investment case for an exposure to small cap Australian equities remains intact, and I'll talk you through the reasons behind that. Again, not trying to take you back to your high school or economics days, but I have surprisingly had quite a number of people ask me, exactly what are tariffs and how are they set and what purpose do they play. So just sort of provide a really back to basics summary here of explanation of what a tariff is, and that is it's a tax or duty imposed on imported goods, and typically in a free trade or unrestricted environment, consumers will import goods when the world price for a good is below that of the domestic price. But a tariff is introduced to increase the world price and effectively make the domestically produced goods more competitive. And that's what's behind, on the face value, what's behind the recent US actions and Trump's announcements. And again, going back to economic principles, the benefit of applying a tariff for a domestic economy is increased production for the producers, protection of domestic industries, and stronger employment and government revenue within that economy. And that's what the President Trump and the US government is suggesting is one of the primary motivations. And it also reduces the level of imports to help the balance of trade. Negative impacts, which everyone's absolutely focused on at the moment, is that ultimately that cost flows through to the consumer, and it reduces the efficiency of consumer choice, but allocation of resources as well. Sorry, just telling you that. Another one, and I said I've actually got a son who's in his final years of high school studying economics, and dusted this off out of his current textbook. But I think it's really important just to talk about the circular flow of income and what are the economic fundamentals that drive the performance of a domestic economy. And all the hype and focus at the moment is around the bottom of this chart, which is the overseas sector, the imports and exports, and what impact tariffs will have on that. But it's really important to remember that there's a lot of other levers and drivers within an economy which will ultimately determine the outcome of economic growth and prosperity within an economy. Firstly, at the top there, you've got how firm businesses and consumers respond themselves. Firms can change their business strategy and their production focus, rates, volumes, and consumers can change their preferences. So a lot of things happen at that level. And again, the level of income for consumers and overall confidence for both those sectors is critical in deciding actually how all this plays out. But what we're seeing as well is the other two sectors, which I think where you're going to see a policy response in the near term, which will be designed to counter the impact of any trade war or tariffs that are being introduced. The first one's around the financial sector, and predominantly this is done by monetary policy. And so how do you incentivize savings and investment? Interest rates are a key lever there. And we've already seen a lot of talk around the impact on interest rates, and I'll talk about that shortly. But it's also very relevant to small cap equities because we've previously reported in some research pieces that we've done that the single primary determinant of small cap equity performance in the Australian market is the direction and rate of interest rates. So it's really important to keep that in perspective on what happened there. And then obviously there's other economic policy that the governments can implement, both within the US and the countries external to the US in response to the potential tariff impacts. And this includes Australia. You've got Australia going through an election at the moment where both parties are talking to tax cuts. And in the US, very much the Trump administration's talking about reduced taxation for businesses and predominantly employees or workers. But then the other side of the equation is government spending. So, what other directed and targeted government spending initiatives can be done to counter any impact of the tariffs or slow down in certain industries? And you're starting to see a lot of that policy starting to come to the fore now. So let's just take a quick step back, and it's hard to keep track of what's the announcements coming out of President Trump's office and the US around tariffs. But effectively, what has been announced at the time of this presentation is that the US government is looking to impose a blanket 10% tariff on all countries, which has now taken effect. But they also announced individual reciprocal higher tariffs for various countries around the world. There was up to 60 countries included in this list, and that was supposed to be implemented immediately as well. Since the major sell-off following that announcement in global markets, President Trump has now announced a 90-day pause on those individual reciprocal tariffs, and to allow for negotiation and outcome. So where all that lands, we don't know. But what's become really clear, and most likely the primary agenda behind all this, is the US focusing on the Chinese economy and China as a trade partner. Initially it was announced that China was going to have dramatically higher rates. That was increased to 120%, and now at the time of writing, I think this is now up to 125%. And this is where the real focus is. So US and China has announced that they'll be increasing tariffs on the US goods as well, and there's all sorts of announcements coming out daily. So this is the real heart and focus of the trade wars. But as I said, the likely ambitions of the US government is largely China focused. But as we, based in economic and fundamental principle, they are looking to reduce the US current account trade deficit, and pay down government debt and protect and enhance US manufacturing, employment, and everything that comes with that. So unfortunately, a lot of volatility and uncertainty at the moment because of the nature of the US president. There's a lot of media attention, so it's probably getting a disproportionate amount of focus from the people on the street as well as the global markets. It's changing daily, and where it all lands, no one really knows. But a lot of commentaries around it's unlikely to last beyond the administration of the current Trump government, and again, increasingly looking like it will be scaled back from the initial levels reported. Again, what we're starting to see is a global response to, one, the tariffs, but two, the uncertainty around all these trade war and tariff announcements that are changing by the minute. And as I touched on, the monetary policies, the first government instrument that's been implemented to respond to these tariffs. And most likely, even though tariffs in isolation should create potential short-term inflation by increasing prices, and that would be more akin to a rising interest rate environment, the broader uncertainty and potential economic weakness around this, and to build consumer and ultimately business confidence, governments around the world are increasingly likely to, and we've already seen actions of reducing interest rates. So a couple of countries around the world have already pulled the trigger in the last couple of weeks, including New Zealand, and a number of other European and Asian countries. The the likelihood of an Australian interest rate cut in May has gone from sort of 40% closer to 100%. And the expectation is that we're now likely to see a minimum of 3 interest rate cuts in calendar year 25. So um, that's the initial response. We've spoken about the broader fiscal government policy response around taxation and targeted government spending. Again, you're seeing announcements coming out around the world on that. So basically, go back to that circular flow of income. There's many levers and impacts on what drives an economy's performance and ultimately markets performance. And we're already seeing these economies adjust. And I think there will be some short-term negative uncertainty, disruption to global economies and global markets. But ultimately, there's nothing unprecedented in what's being discussed and announced that will break the 100-year plus historic relationship of fundamentals on valuation on markets and economies around the world. And hence, we see this as a short-term blip that will settle over the medium term. And ultimately, let's look back at where markets are trading and where they're likely to head from here, and how much of this has already been uncertainty already been reflected in the recent sell-off. Before we get into financial markets, I just wanted to touch on directly the Australian economy. And again, the direct impact of the US tariffs is quite modest on Australia. Again, they only represent less than 5% of our global exports. And recently the Treasury Department's put out some modelling, like post the tariff announcements, and said the potential impact to the Australia's GDP directly from these tariffs is marginal at 0.1%, and potentially a little bit higher in 26. And even the inflationary impact is very mild. So as I touched on, the key concern is the ripple effects or the ongoing secondary impact for an export-oriented country such as Australia, and especially with our major trading partner being China, who's absolutely caught up and is likely to have some pretty meaningful impact from its current trade war with the US. So we'll continue to keep an eye on that. Obviously, there is risk around that, but again, with these other levers, the broader consensus is that it's not going to destroy the Australian economy, or break any fundamental relationships on how we expect GDP and inflation behave over the next 3 years. Just touching on market valuations here. Again, it's always interesting to keep note of, we've seen extreme volatility in my 25 plus years in markets. I don't recall many days where we've had 8 and 10% moves in global markets, so, literally intraday. So again, this is really a reflection, I don't think, of the actual potential impact of these changes. It's the hysteria and media attention around President Trump and everything that comes with that. So yes, it's real, and yes, I think the uncertainty justified a pullback in global markets, including the Australian market. But the volatility we're seeing and the pullback that we're seeing is pretty large in historic reference, and in my view, potentially a little bit overdone. What we've seen is already, at one point the global markets and the Australian markets mirroring that were down sort of 12% in the month of April, and then now you've seen that figures down 4 to 5%. So it has settled somewhat, and acting a little bit more rationally. But not to be too positive about the world, if you look at the trading ranges, which you also have in these charts, the market has fallen along like a gap down a meaningful way, like a 10% plus fall in a week or a day is significant in anyone's definition. But it's still trading pretty much in its historic trading ranges from a valuation perspective, both globally and in Australia. So could it fall more if there's further uncertainty and the flow-on effect is greater than people are currently assessing? Yes, it could, because it's not at all-time lows by any stretch. But again, I really don't think the global economy is broken, or the relationships with the financial markets are either. And I think we're at pretty appropriate levels in light of the current uncertainty in the market, along with the glass half full scenario that things may settle and recover to normality sooner rather than later. What's interesting here is just a bit of a chart, and so the Russell 2000's basically the benchmark for the US small cap market, and it entered what we call bear market territory when it falls greater than 10% in a short period of time. And so what goes through here is some other points in time over the last 30 years where this has occurred, and then how the market has responded following that event. And I'd point to some of the events that drove dramatic movements in the past were a lot more fundamentally concerning and uncertain than what we're experiencing now. But what is more consistent is how markets typically recover following this step down in valuations and share market performance. So typically what it's saying here, within a month, you're starting to see greater than 50% of the time you have positive performance following this down step. We're already starting to see that. But that average return's pretty modest, around 2% positive return for the month immediately following this step down. But what's interesting when you look out 6 and 12 months is that the data's pretty solid in that over 80% of the time you have a positive performance over the 12 months period following this market pullback. And the average performance from this point in time in the low is 20% or a median of 17%. So again, history suggests that we've already bore the brunt of this impact of the uncertainty, and it doesn't feel like now is the time to be selling small caps, either domestically or globally. And again, I just want to share the view, when I say the house view, it's a Greg Taylor view, but I really think the risk to the economy and growth outlook for in the historic events listed in this table were on average quite a lot more severe than what we're experiencing at the moment. So I can't see why these trends are not likely to continue again. Going to talk about Australian small caps, then we'll get into the SB2 portfolio. But again, Australian small caps, we've taken the view on the Australian economy, which should be the key driver of that the direct impact's pretty modest. There is likely to be some flow-on impact, but there's other levers being pulled, including government policy and monetary policy that should soften any negative impact. And so in balance with a sort of 12-month forward-looking view, we remain mildly positive on the outlook. Again, don't dismiss that there's likely to be increased volatility for the next few months, but definitely nothing that should fundamentally break the rationale and logic for having an exposure to Australian small caps. What's interesting is, and I've spoken about this in the past over the last 12 months, the valuations of small caps versus large caps continues to be quite significant, i.e. small caps are a lot cheaper relative to large caps at the moment. And they've kind of moved pretty much in tandem through this experience and recent market dislocation. So again, when we've got a more stable, normalised operating environment, we continue to believe that small caps will close that valuation gap to large caps, and hence is a good place to have some exposure in the Australian equity market. And in light of this lower interest rate environment, dropping rates probably it may be as high as 50 basis points in May, and in continual reductions throughout the year, proven in time historically to be a good positive catalyst for Australian small caps, and I think likely to be again. So not the time to be exiting small caps. Now we jump into the SB2 portfolio, and it's easy to take that kind of balanced view, but we absolutely spent the last couple of months not waiting for the announcement of Trump, but literally over the last 3 months, really digging into the portfolio and say what were the potential risks and exposures of the individual holdings and the portfolio as a whole to these outcomes. The pleasing thing was that, and it's the nature of how we construct the portfolio, is that the majority of the portfolio is expected to be largely unaffected. And the reason for that is, again, we really focus on businesses with intellectual property and operating moats that are not highly sensitive to consumer and business sentiment. So there's a lot of software businesses, a lot of essential services, things like that, irrespective of consumer confidence and the broad pace of the domestic economy, they should have quite defensive earning streams. And again, we're very conscious of valuations as well. And so those two factors, defensive and appropriately valued, though with growth, is how we create. So I've tried to, again, be really balanced about the exposures. There's a few things there where there's likely positive impacts of a falling interest rate environment and increased government domestic spending to counter any impact of tariffs. Acrow's potentially a beneficiary there. Close the loop, big US business I've spoken about in the past, likely to have actually a positive impact. But then I really wanted to focus on where are the risks and the potential negatives. And they're at the bottom of the table here. And I actually spoke more recently I think it was either the March or February webinar around OFX. It was a meaningful position at the end of last calendar year for the portfolio. With this uncertainty around tariffs coming, we sort of highlighted this was a key risk, and we started reducing that position. And it's fallen 40% this year. And we were able to exit the majority of the holding prior to those falls, and now we've completely exited that holding. In saying that, look, I'm not ruling out that it's a holding that may reappear in the portfolio in the future. They're actually a March year-end company, so they'll shortly be presenting their results and their outlook statements to the market in the next month, and so we're very interested to keep an eye on that and see what the future looks like. But on face value, that they are likely to have a pretty direct impact from global trade volumes, and so we've softened that. And another one I've mentioned there is EROAD, which is one we've actually, relatively new name in the portfolio, and again quite optimistic and positive about. There was at the time of writing this presentation, a view that potentially it's a New Zealand economy that sells software, but also some hardware attached to the software into the US logistics market, and so it could be impacted. Actually, yesterday, EROAD put out an ASX announcement commenting on their likely impacts from the tariffs, both directly and from an earnings perspective, through time, and they were very dismissive of any downside risk and quite confident about how the business was tracking. So feeling pretty good about the portfolio. We actually, during these massive times of uncertainty, history has taught me it's not necessarily the time to be too brave or heroic with trading. So we actually haven't done a lot over the last week. We've sort of didn't panic when it was down 12% and didn't get excited when it bounced back. But of course, taking advantage at the edges of some opportunistic trading situations that presented themselves, but very modest trading over month to date, because we've done the work and pretty confident in the outlook. And so, sorry, so that hopefully covers everything. I just wanted to touch on, when I say everything, what's happened that caused this uncertainty in the global markets, our view on it, and the likely impact on SB2 as a portfolio. I'll just finish up with a quick recap of performance, and then also how the portfolio is positioned. So on performance, again, it's been a pretty tough year for small caps for the first 3 months of the calendar year. The portfolio is down 2%, versus a market that's down about 3.5%. So we're never happy with negative performance. I can be certain about that. But it's good that we're not doing as bad as the broader market during this time. But then if you go out more medium term time periods of 12 months, and then longer term at 3 years, you've seen pretty solid performance. And just to give a little bit of color on the performance month to date, uh, the portfolio's been, I think the market's down now as at the time of presentation about 4% again in the month of April. And the portfolio's no worse than that. We had a couple of good days the last few days, and um, you know, hopeful and confident about continuing to outperform the market. But yeah, definitely in line or better than the market month to date. And again, that we're looking at a sort of anywhere between a 3 and 4% down month at the time of this presentation. Hopefully, the recent stability in the market sees that improve, and there's a potential few catalysts in the portfolio with some results due to be announced in the next 2 weeks that will drive the relative performance as well. And then again, this is a chart that I share all the time, which gives a snapshot of the portfolio. Again, a diversified portfolio of circa 25 holdings. The top 5 holdings are listed there. Not a lot of change in the mix and makeup of those. Again, feeling really comfortable about any potential impacts of recent developments on those key holdings, which is good. And again, we've still got this portfolio with, as a whole, greater than 20% revenue growth expected, profitable margins, and quite conservatively valued in some of the metrics there. But again, it's been a couple of years now, and I can retain my conviction that the metrics that we're able to construct a portfolio now are pretty unique in a 25 year time window horizon, and even in a 7 year typical market cycle. So I still think we're at the bottom end of the market and the cycle, and I think the next 2 to 3 years looks very, very good. And we're continuing to be confident in the portfolio. We're positioned to take advantage of that re-rating of small caps through time. That is all. No Q&A today. For full disclosure, we had a few technical problems in the live webcast, so I've re-recorded this. It's the same content information. Though, as always, highly encourage any investors, if they've got any questions, to reach out to myself directly. Always happy to provide more information, and to meet anyone in person where appropriate. So thank you again. Look forward to getting through these cash flow reporting period in the next couple of weeks in the portfolio. Hopefully a bit of more stability in the global ethos and world around us, and we'll be in touch again for next month's webinar. Thank you and goodbye.